Welcome to another edition of Econ Updates. I'm Steve Taddie, Chief Economist with HoyleCohen Wealth Management. Now we've kicked off the new year, everyone's in full gear, and let's take a look at some of the new news that's worth noting. Well, last week we saw the CPI print for the last month of the year, December, and it was a little hotter than most people had thought, coming in at about 0.3% positive. Don't fear, don't fret. The last 3-month average of CPI comes in at an annualized rate of something under 2%. So that trend in CPI being lower is still intact. And that thought is also backed up by the PPI number, which is the Producer Price Index, which showed a 0.1% reduction in that price index pressure, with goods being down 0.4%. If you lift up the hood on that number and take a look at the intermediate and the raw data that feeds into that PPI number, intermediate goods were down 0.6%, and raw goods down 4.4%. The trend is still in, or the fix is in, so to speak. Inflation is still heading lower, bar any unusual events coming up in the future. Wage gains, they've been in the news for the last year. Wage gains are still decent, running around the 4% level. That's been behind a lot of the spending power and consumption we've seen in our economy. As the inflation data has turned lower, the real incomes have turned higher. Real meaning just wages less inflation. So now a dollar's worth of earnings can go a bit further than it went last year at this time. There's a good correlation between wages, earnings, and spending. It's a fairly tight correlation with, as you might imagine, in the US, the consumption growth leading wage growth pretty much every year that goes by. So let's not fight it. Let's just embrace it for what it is. With the increase in real wages due to falling inflation, that could give a little bit of a boost to more consumption as confidence levels get increased for the employed consumers. In the Federal Reserve, we haven't had any news from the Federal Reserve yet with regards to lowering the Fed funds rate, but expectations are that the Fed will decrease rates 3 to 5 times this year, which could take that Fed funds rate from that 5.25% to 5.5% range to the 4 to 4.25% range, with all else being equal and the bond market hangs in there at around this level with a 4 to a 4.25% 10-year Treasury rate, we might see a normalized yield curve in 2024. Hooray, it's about time. Keep that one in the back of your mind for later in the year. On the GDP front, we had a great year last year. It looks like GDP growth might come in at around a 2.25–2.5% number for 2023. Expectations are for about half that level in 2024, with ranges between 0.5 to 0.75 to about 1.75 to 2. Still a large range. We've talked about the ranges on these economic data forecasts being rather large. They're getting narrower, but they're still pretty large by historical standards. We're probably on the north end of the range, expecting a little bit better out of the economy than the pack, basing that on a stronger and more confident consumer with rising real wages and increased business owner CEO type confidence, which should lead to a bit more corporate investment, which tailed off a little bit in the last year. It's still the story. The keys going forward are going to be about revenue and earnings growth. Should be a good year for corporations, as if we get better than expected or better than consensus GDP growth, that would translate into better than expected nominal revenue growth. And if we continue to get the productivity gains that we've seen, that should lead to better than expected or better than consensus earnings gains as well. Where are the cracks? Cracks always exist. The cracks right now exist in consumer credit. Delinquencies are rising a bit on auto loans and credit card debts. The U.S. consumer has always pre-spent wage gains and has always been a bit more optimistic than sometimes their income statement or balance sheets can project. Some will fall by the wayside. Many more will manage their way through an overspending cycle and get back to greener pastures. But that's where we start the week. I thank you for tuning in.